welcome.
Indeed. And with interest rates on the 10-year below 3% because of those worries, many are questioning whether we might be headed for a double dip. So can the stock market continue to move higher longer term if the economy does not recover? Mark Lamkin, CEO and Chief Investment Officer of Lamkin Wealth Management, joins us, as does Kim Forrest, Vice President and Assistant Portfolio Manager with Fort Pitt Capital Group. Nice to have you both with us.
Thank you for having me.
Mark, I'll start with you. Can the stock market move higher longer term if the economy goes into a double dip or doesn't recover?
Well, I certainly think the market's a leading indicator, 6 months forward looking at forecasts. I think the market can lead higher. The thing that has me concerned right now is the ISM gauge. It's that leading indicator of purchasing manager indexes. For the last 3 months, that's been negative, and last month it went from 60 to about 53 in May. That's the biggest drop since 1984, and why that's significant is usually 6 months following that, as we approach 50, the market only returns about 1% as over the last 35 years. The next 12 months, it's only 5%. So I think long-term the market can move higher, but short-term, we've got some summertime blues coming that we're going to have to fight through.
Why will it turn higher? Why will the market rally, in your view?
I still believe U.S. corporate earnings. We had the best first quarter that we've had in history. I think we're on track to match 2007 earnings higher. So I think the market still follows earnings. Job reports and ISM is a concern, but I still think corporate balance sheets and earnings are strong, and I think the market will follow.
Kim, what do you think about the markets right here, especially in the wake of the economic data that we've seen?
Well, I think there's been a real decline in the quality of the data that we've been getting, and by that I mean all indicators point to a softening, if not an outright recession. We'll see in about 6 months' time, you know, what the economists, you know, who bless recessions will tell us. What happened 6 months prior. But that being said, the market is forward-looking. I think there is a soft patch. There's also the seasonal softness of summer, and that means that there aren't that many market participants, so an absence of buyers usually does lead to a decline in prices. As someone who is in charge of portfolios, I'm looking at this moment for good buys out there in companies that we want to own. And that's what we really focus on, is owning companies at a reasonable price. And I think the summer is a good time to try to pick some stocks up there.
All right. Well, Kim, I'll stay with you for that because you both have painted kind of a very cautious view of the next 6 months. So, Kim, where are you allocating cash?
Sure. We're looking to the industrials because America makes really high quality, high value equipment that around the world is in demand. And we're looking at vendors like Boeing for airplanes. We really like the story that around the world, airlines are looking for more efficient engines, and new planes are going to get them the reduced fuel savings. So Boeing is a great provider of very efficient planes. So we think that they're a benefactor of that trend, as is Honeywell, who supplies components.
Mark, since you're cautious, are you holding more cash than you normally do? And if so, what's going to make you shake it loose?
This ISM gauge does have me spooked a little bit. I've raised my cash levels in the portfolios from selling some winners, quite frankly, to about 40%. I'll wait for the next month or two of employment reports and ISM before I really buy with conviction. As far as where we're putting cash right now, I'm staying with the theme of buying what people need, not what they want. Love healthcare real estate. I like technology that solves solutions or enhances productivity. And I like infrastructure or essential municipal bond, high yield paper right now. I think you could get some decent value right now.
All right. Thank you both. Appreciate it.
Thank you
very much.